The top 1% of earners now holds more wealth than the bottom 90% combined. We are building a 4-step wealth architecture plan to bridge that gap, using the same mechanics employed by the ultra-wealthy. This system requires 3 prerequisites: a source of steady active income, a physical notebook for your strategy, and a 20-year mindset horizon. Open your document or notebook now and title it Wealth Architecture Plan. Bridging the wealth gap requires a structural redesign of your capital, moving it from consumable income into productive equity. Most earners are trapped in a cycle of salary dependency, where their income is limited by the finite number of hours they can work. On your document, draw a vertical line. Label the left side active income and the right side passive assets. A passive asset is a vehicle, like an index fund or a rental property, that generates capital independent of your daily labor. Your first objective is to commit 20% of your paycheck toward acquiring a specific asset on the right side of your ledger. Without this shift, your salary functions as a temporary lease on survival that must be renewed every 40 hours. Below your ledger, map out a strict 20-year timeline for these contributions. Compounding interest occurs when the capital generated by your assets is reinvested to produce its own separate returns. This chart compares a spender against an investor. The spender's wealth remains stagnant, while the investor's path hits an inflection point at 10 and 20 years, becoming exponential. Withdrawing funds early resets this mathematical progress, destroying the momentum required for wealth. Wealth is generated primarily by the amount of time capital stays in the market, rather than the size of the initial deposit. Scaling your net worth requires moving beyond personal savings and utilizing strategic borrowing. Good debt is leverage used to acquire a productive asset that produces enough cash flow to cover its own debt service. Follow this sequence. You take a bank loan to fund an investment, use the profit to repay the bank, and keep the remaining surplus for yourself. This mechanic allows $100,000 in capital to legally control a $1 million asset. Applying this leverage to depreciating consumer goods creates a debt trap, as those items cannot generate the cash needed to repay the loan. W-2 employees pay income tax on every dollar before it reaches their account. However, by using asset-backed debt, investors can use depreciation and interest deductions to offset their income, often resulting in a significantly lower tax burden than a standard salaried worker. Mastering this loop allows you to scale your portfolio using institutional capital rather than being limited by your own bank balance. The final multiplier in this system is the human network surrounding the assets. Write down 3 environments, such as investor meetups or private digital forums, to connect with capital allocators. While the public market is open to everyone, the most significant returns are often found behind the closed doors of private deal flow. This network functions as an interconnected web where real estate operators and startup founders share opportunities with investors long before they reach the general public. Operating in isolation ensures you only see the deals that the private networks have already passed on. You now have the 4 components: the asset shift, the compounding timeline, the leverage loop, and the network expansion. This path leads toward a state where your assets cover your cost of living without the need for further active labor. Execute your first asset purchase today. Then, like, subscribe, and comment below with the specific asset you are targeting. These steps only provide real value once they move from the page to the market. Start building today.